Okay, remember this clip?
I'm standing in front of a burning house, and I'm offering you fire insurance on it.
Okay, yeah, so everyone was basically blind to it burning or even just smoking. So the AAA ratings was just hanging on tight and preventing an outright fire, right? But anyway, it will burn. And basically the big shot is betting that it will burn and then making money when it does. And then what do you use to make money? The CDS, the fire insurance. Okay, so credit is like a credit card, it's a loan. In this case, a mortgage loan. So a loan. And then default is when you don't pay back that loan. So when you borrow money, you're supposed to pay it back, but then you don't pay it back. That's a default, so not paying the loan. And then what exactly are we swapping? What exactly is this CDS fire insurance? Okay, simple scenario. Jimmy borrowed $1 million from me. So this is me, then $1 million. Okay, but then Jimmy is a bit dodgy, like may not pay back what he borrowed. So if Jimmy had a credit rating, he would be like a double B. So credit rating is just the likelihood that somebody will pay back what they've borrowed. Double B means a bit ambiguous. It's technically junk, so I'm a bit worried. But then I still lent it to him. Why? Because high risk, high return, he pays amazing interest. So I get 8% per year for 10 years. Okay, but I'm still worried, right? Like, what is 8% if I could lose my entire 1 million in the process if he doesn't pay, if he doesn't come through? So I go to a bank. So I go to this bank, credit rating, double A. Very nice, very reassuring. So I go there and I'm like, hey, I just lent this guy some money. If he really defaults, if he really doesn't pay me, can you pay me instead? You know, because I kind of trust you a lot more than I trust him. So they say, okay, but in exchange, I want 1%. So means effectively, this 8%, I take 7, I give them 1. So the deal that I have with the bank is, okay, if Jimmy defaults, he doesn't give me $1 million, the bank will give me $1 million instead. Then if Jimmy doesn't default, he pays me as he should, he gives me back as he should, then they will just keep pocketing my 1% per year. Okay, so what are we swapping? Effectively, even though you see I am lending money to double B Jimmy, because double A bank says that they will pay me instead, I am effectively dealing with a double A party, right? So I am literally swapping out the likelihood that my loan will not be paid back. I am switching out a double B for a double A. This double A will override this double B. I am literally swapping out a BB likelihood with an AA likelihood. Swapping out a dodgy person for a more trustworthy person. That's the swap. Okay, and you see this part is exactly like an insurance. So you know insurance, you basically, I pay a small premium, then if somebody dies, then I get a large lump sum of money. Or I pay a small premium if the house is on fire, then I get a large lump sum of money. So in the same way, I pay a small premium. If Jimmy defaults, I get a large lump sum of money. So this insurance, the name of this insurance is the credit default swap. But then, key question, why would the bank agree to this? Like if Jimmy is so likely to default, they're definitely gonna lose that 1 million, right? Okay, the thing is, the banks, they did not see the risk. They did not see Jimmy defaulting. Why? Because Jimmy was disguised as AAA. So the banks effectively, they believed in this AAA. Despite being actual junk, right? They believed in this. So they believed that Jimmy will not default and then they can just keep taking my premiums without ever needing to pay me 1 million. So you see, Jimmy is essentially the MBS, right? The MBS and the CDOs in the big shot. So in the same way, Michael Burry went to the banks because he knew that the banks did not see the risk. The banks did not believe that these MBS and CDOs would fail. Because why? Exactly the same thing. They were disguised as AAA. So that's why when Michael Burry went to the banks, went to Goldman Sachs, went to Deutsche and offered them premiums for the CDS, they gladly agreed. So it was a clutch for Burry, right? Only Burry saw that it was junk behind. Only Burry saw that the house was burning and bought a fire insurance. Only he saw that the bonds would fail and bought a CDS. So the banks who didn't, who only saw AAA, they gladly agreed. They just took it. They thought it was free premiums. And anyone can buy a CDS. Like, you don't have to be like me and lend out this 1 million first. Not necessary. So they can just buy this part as a CDS. So Michael Burry, Mark Baum, all the main characters, they bought the CDS, right? So they have the CDS and they just wait for a mass default when the loans reset. So in the movie, they said most were adjustable rate loans, right? So effectively, so let's say in the first 2 years, they get like a promo rate. So they pay a very small amount, a promo rate, a teaser rate. Then after 2 years, they start paying the normal rate, which is a lot higher, right? But then they didn't know, they literally either didn't know that they were going to pay a much higher rate, or they just couldn't afford it. Or they were told that, okay, they could refinance, but the housing prices didn't go up, so they couldn't refinance. So after 2 years, surprise, surprise, it went up. They couldn't pay. So mass default, all your CDOs, MBS, your housing market, everything all failed. So now the house is really burning. It's really burning. And then everybody who bought the credit default swap, who shorted the housing market, the bonds and everything, they all get a handsome payout, right? And then the banks, the insurance companies who could not pay out everyone, they collapsed. Or they had to be bailed out. So it's like big brain, big shot, big money.